let's say it's 30. It's easier to count. For 30 Swedish crowns.
Okay.
And the strike price is 240. And the current price is 206. How normal is it to be forced to buy, or I mean sell the stocks even
Well,
if it's not close?
if you're running a strike price on a call, and you sell the call, and the strike price is below the
Stock price,
you will get called.
Okay.
Because, yeah, am I saying that right? Yeah, because, whoever owns the call, they can immediately buy, or they can immediately call your shares and then turn around and sell it in the market for that profit. So you will get called every time.
Okay.
Hello, all good.
Hey, how are you, Randy?
I'm good.
Good.
Hello.
It's our friend from Sweden.
Yeah, Osmetna.
Awesome. We don't get to see your face, right?
Not yet.
Okay.
Don't be shy, we're friendly.
Yeah, I'm sure. I mean, Randy's the boss. If it's okay with him, it's okay with me. I prefer when I have my Saturday night parties, I prefer everybody, it's a video chat, so everybody has to kind of show their faces. So, because it's more fun. But here it's different. Here it's Randy's game. So whatever goes with him, fine with me.
Well, right now I just want to get people here and knowing it's here every Saturday, and once people start showing up, then we can get a little bit more particular about it.
Sure, no problem. Because it is better to see people's facial expressions when they're talking than when to just see a blank, just the name. That's the only reason. I have lots of questions for you, my friend Randy.
Okay.
So you want us to wait till more people show up so everybody can learn from each
Yeah,
other?
let's give it 5 more minutes, and
Sure.
I'm actually gonna let. How do you say your name? Smith. How do you say your name?
It's really like a really bad type of something or something.
How about I call you O?
Okay, it's okay.
Okay, so I'm gonna let O start because I think he's overseas, and on a time difference, and I think he said he can only stick around 30 minutes. And
Sure.
Yeah, something like that. It's a birthday party.
oh, okay, but you got to keep the kids happy.
But this is more important than the birthday party, so they can wait.
What time is it at your place? Oh,
It's 5 p.m.
5.
Oh, okay, so you're not really in the middle of the night then.
No. But it's in the middle of the night when you do the night thing or the evening thing for you. For your time.
You mean when we do it on Thursdays?
Yeah, it's what time is it? It's like
Yeah, we are 8 here at 8 at night, and yours will be, I don't know, what in the morning.
Yeah, it's like 4 o'clock, I think, or something.
Oh,
3 or 4.
all right. It's nice to meet you, and I see you on Gen X Discord, commenting. So it's nice to talk to you like this way.
Yeah, the same.
And we have something in common. Like we are all doing options and learning from Randy. He's our teacher, so and an expert. So lots of questions.
Yeah.
It's fun. I'm enjoying it so much.
No, I haven't done any option. What is it called? Anything with options yet, because I'm a bit afraid to do anything yet.
Right. That's true. And but my experience is that I've recently started. This was my 3rd trade. That you have to really in your mind when Randy shows you the option trade and all that, in your mind, imagine all that. It's much easier when you visually see it. It's much easier.
Yeah. Yeah.
Than hearing someone say something. And of course, if you put your money in there, you learn fast.
Exactly. Hope my fan doesn't bother you, because it's really hot in Sweden here and we don't have any air conditioning. So.
No, I don't hear any fan. I don't hear your fan.
Good.
Yeah.
Yeah, you don't live in Texas without air conditioning. It's way too hot.
So how does this usually work? Randy just starts.
Yeah, so far we're just figuring it out.
Okay.
This just started. So basically, I just come on and I open it up for you guys to ask questions. It's not really like a class. It's just you let me know where you're at and what you think you need help with.
Okay.
So I guess we can go ahead and start. So fire away.
So who should start?
So, are you looking to, or do you already have stock that you own and want to just sell options on it, or are you just looking to sell premium and trade options?
I'm looking for the premium right now.
Okay. So.
But the stocks I'm actually looking at, I don't mind if I have to buy them also, but
Okay.
I'd rather not buy them if I say like that.
Yeah,
So it's not a catastrophe if I have to buy.
Yeah, I was looking at your, what I could tell, the bid ask on your options are really wide. Are those stocks traded in high volume, or just like on the pink sheets or something?
No, this stock, the 26.70 Swedish crowns, it's like $20 or something. And the buy and sells are around 26 cents up to $3 between there. The spread, everything.
So, but what kind of volume are those options getting? Can you tell, or you need when you trade options, you need to have a lot of volume.
Sell volume, right under the pot. It says like a LJ volume. That's how many they are. How many?
I'm sorry, I didn't catch that. I'm just worried that you're looking at your bid asks that are pretty wide, and you're calculating on the top side, and I think that can get you in trouble. Because until you actually go buy or sell the option, you just have to pay what the market will bear. So you really need to do your calculations based on the lower end of the spectrum. So if the bid is the lower number, then you need to do your calculations on that if you're selling, or if you have to buy it back, you have to go to the top end and pay the ask price. And I'm just afraid that, I saw in the chat that you were doing calculations just the opposite. And so it does look like it's really gravy, but it's not always as easy as it might look.
Yeah. Well, I'm having a little bit, I don't know if I would say difficult to understand, but basically to buy, there's, if you don't think the stock is going to go up a lot, like 15-20% in 1 month, then it's kind of not useless maybe, but not so smart to buy calls. If I think the stock is like 100, and I hope the stock goes up to like 130, but it doesn't go, then it's just I only paid for the premium and I got nothing for it, right?
Right. Yeah, when you're buying premium, you got to be right in the direction and the time frame.
Yeah.
I have a quick question. What stock are we talking about, Randy?
I'm just talking in general.
Oh, I thought you were talking about a particular stock. Okay.
Well, I think he was looking at like some kind of fingerprint company or something like that in the chat.
Yeah, I've looked at several companies. But the problem is that I cannot buy any kind of American options at all. I only have Swedish, so it's kind of sucks. I cannot, if I want to buy like AMD or whatever, I cannot do that because.
Is there some reason? Is there a restriction in your country, or?
Yeah, I think so. Or just maybe no market, or I don't know, some kind of.
Have you looked at Interactive Brokers? They do a lot of different countries.
I didn't really look at it yet. I might have to do that. Usually they have very high fees for, I think.
Yeah, I don't think they would be high fees. They're really pretty reasonable. I would check it. I would check it out because if you can open up the American market, the world's your oyster. Yeah, there's lots of options to choose from there.
Okay. I'll definitely have to look at that.
Yeah. Hello, Harrison. You with us?
Huh?
Did what flashed up? Harrison, are you there?
Hello, Harrison. How are you?
Hi, I'm good. I'm just talking in.
Hello.
Hey.
Okay, so any more questions, O?
Well, the question I'm thinking more like which would be the best to start with, if there is any best kind of option to start with. I'm thinking like sell put. If I think the stock is going up, I mean.
That's my primary strategy.
Okay.
And then if it's put to me, then I'll just turn around and sell calls on it till I unload it.
Yeah.
But
so because I'm trying to understand the risks with losing money. Let's say I just take a hypothetical stock at 100, and I sell a put for 90, and I get a premium of like 5, let's say.
Mm-hmm. So your risk is that you have to buy the stock.
Yeah.
So, the number one take is don't sell puts on stock that you don't want to own.
Yeah.
And then the further risk is then that the stock continues to deteriorate. But at least you've got the premium, so you've got it at a lower entry than if you had just bought the stock outright.
Yeah. So let's say I get called on the 190. The stock was 100 when I put the strike price of 90, and I got 5 premium for that. And then I get called, then I have to pay the 90 for 100 stocks. So it's.
Well, you're not going to get
paid 85.
You're not going to get called. You're going to get assigned.
Yeah, assigned.
So, yeah. So then you would have the stock assigned to you at whatever the strike price was, minus your put premium.
Yeah.
Yeah, I think you got it.
Yeah, that's the only one thing. It's kind of like, it's really, just like have to change the way you're thinking, like turn around the like selling and buying. Feels like a little bit, it's not like intuitive and stuff.
Yeah, there are a lot of videos on selling premium to the put side out on YouTube. Just look at a few of them and until you get comfortable with it. But what I like about selling put on the put side is if it goes against you, you can always manage that trade. And in fact, just this week, Facebook made a big drop, so I'm in an upside down position on my Facebook trade. So I'm going to be making videos showing people how I'm going to manage that trade. I'm just going to go out there and I'm going to buy that option back, sell another lower option and lower the strike price on it, but sell it in the future, and the premium will pay for buying the stock back. So I'm not going to take a loss on it. I'm just going to manage it.
Yeah. But that's the next level for me, so I'm not there yet.
Well, you need to kind of know how that would work, just in case your trade does go bad, because it happens. This market is crazy. It goes up and down, so you just have to, know what your options are and how to deal with it.
I have another question.
Sure.
Let's say I do the stock is 100, and I do strike put sell for 100. No, not 90. I mean. Then I get the 5 premium. But I also do what's it called sell call for 110. Then I would also get the premium for that, right?
Yeah, you're
So I
not.
would have double premiums.
Now
both for
you're
sell and
talking
call.
about straddles.
Huh?
That's another a term that you'll learn about. Straddling is selling both sides at the same time, and it can be very
Okay.
profitable. What you want to do on straddles, if you have a stock that doesn't move much, and that way you can get on both sides and double your premium. But that is a little bit more advanced.
Yeah. But even if I would be called on the like 90, something like that, I would still get the premium for both options, and I would have to buy the stocks at the price.
Yeah, I really can't tell just from that. I mean, we would have to look at, all the dollar amounts and stuff. So, yeah, it can certainly be done. If the stock plays nicely for you.
Yeah. Okay.
I would start just working it on one side, though.
Yeah, of course. Not too complicated first.
Yeah, options can get all kinds of fancy configurations, and a lot of them work and a lot of them don't. And I've basically gone just down to the very simple selling puts and selling covered calls to exit the stock, and I don't do any of those anymore. You don't need to.
Okay. Also, the stock markets are really wild now, up and down.
Yeah, they are.
Really, so it's especially now I'm even more a little bit afraid to start doing anything because
Yeah,
it's not easy.
It's just all about managing your risk. Just work with don't over leverage yourself, and work with what your account will handle, and you'll be okay. Start with small steps. Start with the non-risky steps, and just take little small wins until you get comfortable, and then you can ratchet it up as you learn more.
Yeah. But did you say that if I do a sell call, if the stock is 100 today, and I do a sell call for 120, 120, and I get a premium of 5, I would always get called? Or?
You will never get called unless it reaches the strike price.
Yeah, of course. The stock price has to go up to the 120 or higher. That would be, or it wouldn't be any
Right.
risk of getting called.
So
Right?
it just depends on how volatile the stock is. I think, U.S. options you can exercise at any time, I know that some of the European options you can only exercise on the expiration day. I don't know what
Yeah.
Sweden rules are.
I checked that up. This is kind of weird. We have European stocks, but we have used the American style of the options, so they can buy or call the option whenever they want, not just on the expiration date.
Yeah. Yeah, so,
The brokers I use, I mean.
well, I think the brokers are going to have to go by whatever the country standards are, so
Oh, okay.
it's going to be the same from one broker to the next. But like I say, if you go check out Interactive Brokers, I'm not sure they work with Sweden, but then you could do U.S. options and do the U.S. options rules.
Yeah. Okay. Well, thank you for the few newbie questions for me.
Just keep hanging out in the Discord, and just when you have more questions, just let me know and we can answer them.
Yeah, I appreciate the help and the time.
No problem.
I'll stick around a few minutes.
Okay.
Listen if you learn something. So, thank you for today.
Sure. Hey Harrison, you got any questions for us?
Sure, I got a plethora of them.
Okay. Are you trading options now?
Yeah, of course I do. I do that regularly.
Okay.
So it's very familiar terminology for me. I do what you guys consider really risky. It's like I do like intraday options, and I just basically flip the premiums, and I trade based on technical analysis.
Okay. How's it working for you? Is it profitable?
Right, yeah, yeah, profitable for sure.
Cool. What do you trade on? What
I
stocks?
trade on Thinkorswim right now with TD Ameritrade.
Yeah. No, I'm talking though. What underlings do you trade?
Sorry?
Like Visa or a penny stock or?
Oh, I trade usually SPY options. I like looking at Tesla just because of the volatility of it. If you can capture the upside or downside in Tesla, it's really profitable.
Yeah,
That's what I'm working on learning right now.
Absolutely, I love Tesla for that. I'm currently a little bit upside down after yesterday, but.
Oh yeah, for sure. Yesterday was such an anomaly.
Yeah. Yeah, that, and I got dumped on Facebook too.
Oh god.
Yeah, I had like a $3 put that's now like at about $30.
Oh my god. Was that a buy or sell?
No, I sold it. I sold the premium. So next week I'm going to go in and, roll it down and roll it out a month and give Facebook a chance to recover. That's the only thing to do with that thing.
What happens when you roll a contract?
So you go in and buy the old one back. So I had like $3 premium in it. Well, actually, I think it's about a $50 premium now. So it's going to cost me $50 to buy it back. So I'm going to take a $47 loss, and then I'm going to go out to a month out and buy the similar one, and it's going to pay me about $50 in premium. So I'll end up with like a $3 profit. I just have to wait a month.
So what's the actions that are taken after you roll it? You roll it, that means you get rid of the contract that you're currently in?
Yeah, I will buy the old contract back, so then I'm completely out of the trade. I could walk away right there with a loss and be done.
Mm-hmm.
And then I go out and I sell like a 30-day contract to get my premium back. So I come back to even.
I see. And
So
that's just the value of your
it's just two transactions. It's two transactions, and we just call it rolling it.
And in every situation, rolling a contract would net you that $3.
It will net you something positive.
Okay. Is
So
that something you do often to profit?
that's what you do to save your ass
You buy back your contract and then you
and to sell it again.
sell another one.
The market pays you to wait because the options are built with profit in there for this option seller, and you get that time premium. And so I'll just put it out there for a month, and Time Decay will start working on that contract, and I end up in the green.
Oh, this works on your side, right? Time Decay works on your side?
Absolutely.
That is so weird. That is a foreign concept to me. Usually Time Decay is kicking my butt during the day.
No, you want to be selling premium long term and just let it work for you. It's beautiful.
It seems really more like safe, like honestly. Usually if I see traders that trade intraday options like me based on technical analysis, sure, it's profitable. But if you're going into trades and you don't know where you want to enter and exit, which I see numerous amounts of people who are new to options do, it's just crazy because you lose like 90% of your portfolio in a play if you don't know how to handle your risk.
Sure. Yeah. Yeah. A lot of people don't believe how simple this is and how safe it is. Like, well, yesterday my portfolio was down $7,000, but I have absolutely no worries with it because all I'm going to do is roll these big snafus out for a month, and it's all going to decay right back into my portfolio.
That's gonna net you over $7,000 in.
Yeah, I was on the negative side yesterday for that because I was on the upside down of Facebook and Tesla and Amazon. But my account's pretty good size, so I swing $5,000 to $7,000 a day almost every day.
I see.
But over the long term, I'm up 15% this year, and just this last month, I think I'm up at like $12,000 for the month.
Wow, and that's just from capital gains as well as the
it's just premium
options gains.
Premium. It's all premium.
All premiums. Wow. 12,000 all premiums. That's great.
Yeah. That's why I'm trying to share. That's why I'm trying to share this. It's beautiful. And it worked. It worked through the pandemic, so it'll work in about as bad a situation.
Oh, I'm sure options traders are profitable in all market conditions.
Yep.
As long as you play the right hand.
Yep.
Where should I start to actually? I think my problem right now is I'm not really piecing together what selling an option is and how it works, I guess.
Say that again?
I think my current question would just be how it actually works. How it all would play out on a day maybe. So say I'm trading Cisco stock sitting at $45. What would prompt me to sell a put, sell a call, or sell a call?
Well, you'd only want to sell a call if you owned the stock.
Okay, so if you're playing with cash secured or if you're playing just cash secured, you'd only want to sell puts, not sell calls.
Right. So if I can't really help you on day trading because there's not. On day trading, you really don't have any time decay. You're just timing the market. So let me do this. Let's see if I can share the screen. Oh, it's not logged in. Let me log in real quick now. Thinkorswim. Okay, so you say you're looking at Cisco.
Yeah, Cisco.
So okay, you seeing my Thinkorswim screen here?
Yep, all clear.
What's the symbol ticker for Cisco? C.
CSCO.
CSU. That's not one I trade, so. Okay.
Do you trade everything in your watch list?
No,
No? Okay.
not at all. So I would look at Cisco and I would look at a 1 year, 1 day, and I would see that it looks like it's got resistance about here and it's got some support about here. And I look at over here and see that currently at 44. So I'd go out to trade and I'd look at, well, this would be next week's Friday expiration. And I look at probability of out of the money, and I'd come down to around 68%. And so I would go out here and look and sell a strap at 45 for about 40 cents.
And you always look for around 60-ish percent?
Around 68.
68, okay.
And the reason I use 68 is it's on a mathematical formula on, I forget what it is. It's where 95% of your trades will fall into that percentage. So you have about a 68% chance of winning this trade in, and it'll close in 7 days.
And you
Or 5
always
days.
do, normally, you always do options with week expiration?
I used to do about 2 or 3 weeks, but the markets are so choppy now
Right.
that I've pulled it in.
Really.
But I like to at least have a weekend in there because time decays your friend, and I like it to decay over the weekend.
So this is a week contract. So if you bought it on Monday, you wouldn't have that time decay, right? So you'd probably want to look at July 10th maybe if you were if I was playing a little bit longer per se.
Sure. So let's look at July 13th and a 68% in there. But gets you, about a 60% premium. And you can always buy it back at any time. Like, you trade, intraday trade them. You can, if they start going against you, or if the stock moves, if the stock moves up, this is going to fall, and you can just buy it back then. It's certainly not as exciting as day trading them, but it's a little bit more consistent.
Right, that's 100% what I'm looking for. Just that consistency.
Yeah. Let's see. Yep. Yep, it'll give it to you there.
So what would prompt me to sell the call at that 44.5 strike price?
That's the $1,000,000 question. You mean the put? You said call.
Oh, yeah. Put. Sorry. Yeah.
Yeah. You know, you do your technical analysis, and you just, it's a call on what you think the stock's going to do. I like 68 is just a starting point. If you want to be a little bit safer and not get it assigned to you, sure, drop to the 44. Then you get a 73% chance of winning. And if you want an 87% chance, do the 41, but you're only getting probably 20-cent premium. The better premium is a little bit higher risk. If you actually want to buy the stock, and you don't mind buying the stock, go right close to in the money. When it's 46, so sell at 46.50. So it's going to pay you $1.70, maybe say $1.70. And if you don't mind owning it, then your actual entry price into the stock is going to be like 46.30 minus $1.70. So you're buying it at what, 45 something.
So to reiterate that, let's go with the at the money option. So currently the stock price is 46.31. If I were to buy the 46.50 strike, or sell it. Sorry,
you're gonna
if
sell
I
it.
was to sell the 46.30 strike, 46.50 strike at 174, and somebody buys it, I will get it assigned, right? Because somebody's gonna buy it since it's at the money.
Yeah, most likely at 46.50. Well, it just depends on where the stock is on the expiration date. If it's above that strike price, you will get assigned. No, I'm sorry, take that back. If it's below that strike price, you'll get assigned. So say you sell the 46.50 strap, and on expiration Friday the stock is trading at 45. You're going to get assigned that stock at 46.50 because that's the strike price. So you'll be $1.50 in the hole, but your premium will cover it at $1.74. But you will own the stock at 46.50.
Well, that wouldn't really make up for the loss, right? Since I'm $1 multiplied by 100 down the hole.
Yeah, you kind of broke up, but yeah. So go ahead.
What I was saying was like that wouldn't really cover my losses, right? Since the stock price would be like 45, and I'd be $1.50 down the hole, right?
Well, you'd be about 25 cents a share ahead.
25 cents a share.
Yeah. So, because you're gonna
premium multiplied by 100 as well. Sorry.
Yeah. Yeah, we're talking about. So everything's times 100. So it'd be $25. Because you're getting paid $1.74 to take the risk. Now you wouldn't want to do this on a stock that you thought was going down. You'd want to do it on a stock you think's going up or staying even. So if you sell the 46.50, your best possible outcome just to collect premium would have the stock close above 46.50. You keep the premium and you don't have to buy any stock.
Well, if you sell the put at 174, right, at that 46.50 strike, your goal to profit ultimately is the stock price goes up and you don't get assigned, and you profit off the premium.
Correct.
After selling it, come expiration.
Correct. How
would your premium increase since you're selling puts if the stock price goes up?
The premium does not increase after you trade. Your premium is whatever you traded it at.
Yeah, but how does the value of the premium increase?
Well, on a put, the value will go up when the stock goes down.
Right, right. But I guess my question is, if you the trader is wanting the stock price to move upwards, so you don't get assigned, how would you profit if you're selling a put?
Okay, when you sell the put, if you sell this 46.50 for $1.74, that would be your premium. So you'd make $174, and it doesn't go up. It's just whatever you sold it for. Now, if
It's clicking. It's click. Okay, okay.
the stock price is above 46.50 on expiration, you don't have to buy any stock. You just walk away and you're done, and you can turn around and sell the next put.
So I'm basically getting paid $174 for nothing.
You're getting paid that. What you're doing, you're selling insurance. So someone's afraid it's going to fall, and they'll pay you for it. So that if the price, let's see, did I say that right? It's too early for me. So yeah, you're wanting the price to stay above 47. So what you're doing is ensuring to someone else that it does not fall below that price. Because if it falls, say the stock falls to 45, your strike price is going to trigger, and you're going to buy it out of the market for 46.50. So they're getting a guarantee that they get at least 46.50 for their shares, and you're getting paid that premium to provide that insurance to them.
Oh, that makes perfect sense, actually.
Yeah, once you wrap your head around it, that's what you're doing. You're selling insurance.
Okay, yeah.
And insurance.
Yeah. Okay, so I'm getting it. Yeah.
And insurance is expensive. That's why I like to sell it and not buy it.
Right. Okay. So this is wow. Why don't people do this? This is like significant upside. Okay. Okay.
Yeah. Once it clicks with you, it's like, oh my goodness.
Okay. Yeah. So if I'm selling that 46.50 at 174, and it's just gonna sit there until somebody buys it, right?
Well, yeah. You just have to monitor your stock and see if the stock has gone low. So if the stock has gone down to 45, you're going to get assigned. So you may want to roll it out to the next month at a lower price and get paid again. Because say it gets there, and you're looking at and it's going to get assigned to you. So it's at 140 now, and let's look at the next one out at what's that? 46.50 is 174. Let's go to the next. Let's give it. Say we want to roll it up 2 weeks. 46.50 is now going to pay you $5. So if you get in trouble, you roll it out again and you make more money. You can't screw it up.
And that's just like an automatic fight. Like you don't lose out on that.
You buy the old one back at $1.50 or about whatever you paid for it, and you sell the new one. It will always work in your favor because what you're doing, you're selling time. This one's further out in time, so it's worth more. The very same strike price is worth more further out in time. You just have to wait for your money. Well, you get the money immediately, but you're just obligated to that share for another 2 weeks to that contract.
I see. And then after this one after it's the time of expiration for the one you rolled out, what would happen from there?
Well, the first one you bought it back, so you're relieved from that contract.
Mm-hmm.
So the new one, now this one has 27 days. So you can what generally happens in that 27 days is your stock will go up, this will fall, you buy it back, take your profit, and walk away. Because if
I see.
if the
God, it's okay.
Yeah,
Okay.
if the stock goes up, this price is going to fall, and you can buy your option back on the cheap.
Okay. So at that point, so from finish start to finish, if you're buying a weekly option, so seven days out, and you're buying it at let's say 46.50 for 174, and if at the time of your option's expiration, the stock price is trading under 46.50,
Right.
you can save your ass by rolling it to July 24th, 27 days out,
Absolutely.
and you wait for it to
To go
you wait for the
profitable.
stock price to go up,
Yep.
and then you wait to buy your premium back at lower than 174.
Well, no, you've already bought that one back, so don't worry about that one. So now you're just looking to get a buyback under $5 because you just sold this one for $5.
You sell that one for $5?
Yeah, when you sell the new put, this one will be selling at $5. So now you only have to get, this price under $5 because the other one washed out. You already broke even on the other one. Actually, in this instance, you're a $3 ahead. So, yeah, I mean, just do the math. It's
sorry to just interrupt here. I'm just going to say thank you for the Zoom meeting, and I'm going to head off now.
okay. Well, I appreciate you coming by. And you can check back next week too if you want.
Of course, I'll come back next time. So
Okay.
good luck. Thank you.
Bye. Bye. So yeah, this is why I like to sell premium.
Yeah, I think I'm gonna like it too.
It works really well. It really does.
I think it's just once I literally gotta just wrap my head around it because I'll be playing both sides of the game. It's just really weird.
Well, you can still play both sides, just do it one at a time. So, if you're not day trading, if it's actually a stock you want to hold, just go ahead and go real close to at the money and let it get assigned to you and then start selling covered calls on it. The trick is don't get involved in a company that's like PCG or whatever it is that's, going bankrupt. You don't want to mess with those. That can leave you in a mess. But, stick with the nice companies. So what you thinking? Just gotta let it sink in.
Huh?
You just gotta let it sink in.
Yeah, I'm still trying to wrap my head around the whole wash sale concept.
Okay, so let's go back to the 13th. So let's say you got a premium of $1, or let's say $46.50. You got a premium of $1.74. So what's going to happen if the stock goes against you? This premium is going to go up. Say it goes up to 325, okay? So you got premium at 140, but it's going to cost you $3.25 to buy it back. But you want to buy it back because you don't want to get assigned, right? So you pay $3.25. Now you go out your 2 weeks and you're $46.50. Now you can sell this for $5. So your $5 covers your $3.25 that you had to buy your old one back. So now you're ahead of $1.75. So once this decays to 175 or less, then you can exit the contract even.
Which is buying that one back, right?
Right. You buy it back for $1.75.
Wow. I'm getting it.
Yeah.
All right. Sounds that's great. Okay. Okay.
And you only have to do this if your position goes against you. This is just a way to make sure that no trade costs you money.
Right. Okay.
And when you get that under your belt, then it all becomes gravy because everything's a winner.
Yeah, I think I just need to go ahead and learn some more. Probably. I got the I guess this would be called the beginner concept. I think I got it now.
Cool.
What would be next in terms of learning? I guess.
Doing it and repeating it. This is as complex as I go.
Okay.
This is my whole system.
Just trying to profit off that premium and rolling it if it goes against you, huh?
Yeah. Yeah, if you don't have losers, then you don't have to have big winners, though. Winners just keep adding up.
Right. Could we maybe do another example on stock ticker T?
T?
Yeah.
Sure. Okay, so let's say we want to do a 13 days out, and we're at 29 bids, so I would come over here and look at 68%, so let's go 65%. Sell the 28 strat at about 50 cents.
Okay, just in the middle of bid and ask.
Yeah, I'm just guessing, between the bid and ask. You try to get your best, something in the spread. So say it goes against you. So you're in it for a strike at 28, but it dropped to 26. And say that it's going to cost you $1 to buy it back.
Okay.
So let's go out and let's look 30 days out. And so you look at what you can get $1 for. So you can get, you can sell a strike at 28.50, which is about where you're at now, or a little less. You get your $1.10 back, so you're back to even, but you got 27 days to let T come up.
I didn't really get that part when you rolled it to the July 24th. Could you reverse it or back up to the
Okay, so
yeah.
So you sold the 28, and you got 55-cent premium, right?
Yeah, so you pocket 50 bucks.
55 cents, yeah. So, but now come expiration day, it's trading at 26. So you're going to get assigned at 28, right? You don't want to take the stock, but at that time, to buy it back, it's going up because it's going down because the price of the stock's going down. So it might cost you $1 to buy it back. So you're 45 cents negative, right? So you're at negative 45. So what you need to do, go to the 27th, and go back to 28, they're going to pay you about 80 cents for a put to the 28th. So you're gonna cover your loss of 45 plus get 45. So you get another $45 to wait for 27 days.
Can I repeat it back to you and you maybe tell me if I'm understanding it correctly?
Sure. I'll come back here.
All right, so I'm selling the 28 strike price for, let's say, 50 cents. Okay. Nearing the expiration date, the stock goes down to 26, so the premium is at $1.
All right.
I pay $1, so I'm negative 50 cents to roll the contract over to the July 24th.
Right.
And I choose a higher strike this time, maybe 28.5, sure, for $1, let's say $1.10, just to make it easy.
Mm-hmm.
So at that point, I would, I'm at down 50 cents. If
And
I'm selling this contract, I'd be up 60 cents.
correct.
And I would just have to wait until expiration and the stock price is higher than $28.50 to be able to claim that 60 cents, so $60.
Now you get the $60 immediately.
Okay.
So yeah, then you're just, your old trade's done, and so you're just watching this one. So you let Time Decay start working on it, and when this gets below 110, then you can exit the trade immediately with a profit and not be under any more obligation.
Wow. So at that point, I already pocketed 60 cents. I'm just in the trade, right?
Yeah.
Okay. I'm just in the trade waiting for the stock price to rise up so the premium would go lower, right? For buyers.
Exactly.
And then when would I profit? When I buy back my sold put?
Now you get the cash into your account when you do the sell. What you do when you buy it back is you just relieve the obligation. So you'll actually have to pay to buy it back. So you'll lose a little cash out of your account, but the contract is then goes away.
So relieving your position is different than just buying it back and getting out of the trade, right?
Yeah, well, no, it's the same thing. It's just so when you buy your put back, you're no longer obligated to buy shares anymore. So it's just exiting the contract. It's sell to close. No, it's buy to close. So you sell the contract to open it up, and then you buy it to close it. And then you're just even Stevens again.
Okay, I probably need to get some more experience on this. I'll hop in the what's it called, the
Discord.
TD Ameritrade.
Oh, okay.
It's like the day replayer or whatever. I'm probably gonna need to do some trial in there.
Yeah, it's mind bending until you get your head around it. But then when it clicks, it's just all good.
Yeah, I think I'm good at the first part though. Just how you would profit and what would happen if the trade went against you. I think I just need to see it happen during the trading day to be able to actually comprehend what I'm doing.
Yeah, well, or you profit is when the stock is below your strike price and you get to expiration. That's where you truly profit.
Below the strike price or above?
Yeah, above. I'm sorry.
Okay. That's where you earn your profit. Okay, yeah, that does make sense to me. I think this is a matter of seeing it in action. Did you go over anything else with Allgood and Osmith before I came? I know I came late.
Yeah, all good. We were just waiting for her for because he was going to be on a short time frame, but we went over. I don't even remember now. I'd have to review the video.
Okay.
I've got a short memory.
No problem. I'll take a look at that later.
Okay. Well, if you haven't got anything else today, I think Olga's been patiently waiting, so.
Yeah, yes, no, I'm learning. I learned a lot while Harrison was questioning you. It just made sense because I'm in that position right now, and that is what I wanted to discuss with you. And all right, if we go to, I bought Cisco, the other one SYY ticker symbol on the, let's see, where was I? Yeah, on the for July the 2nd. Okay, I'm confused here, Randy. July 2nd is Thursday. Friday is because Friday will be closed for the Independence Day, right? Is that the reason?
Yeah, I think July 2nd, I think, I don't know what day that is. Let's see.
Yeah, it's next Friday. I believe it's market's closed for Independence Day.
Yeah, actually the 2nd is on a Thursday, so that's the last trading day.
Right, so that was kind of throwing me off, and I said, oh, okay, this must be the reason, because always it closes, the expiration date is always on a Friday. So anyways, I bought Cisco, and I bought it yesterday, yes. And what happened was that it is going against me. It was like 51.50 put for 81 cents. And now it's, where is it?
$1.55.
Yeah.
Okay. And so I'm assuming you don't want to buy Cisco?
Okay, July 2nd. So now if you see 51.50, it's like 50 or 56% probability of being, assigned to me.
Uh-huh.
And it's gone up. So the same rule applies as you're telling Harrison that I have to buy it back, but I would be losing money on it because now I'd be paying, I don't know, something between $95 and $1.55, where the premium I got was $81. So then what I do is like you were teaching him, I roll it out because I'm losing here. Because I really want the premium, I don't want the stock assigned to me. So that's a sweet deal. I mean, I did not know. This is what I learned. Like you were teaching Harrison that I can go further 2 weeks and then buy it back. And this I will sell, but I will lose money on it. But when I turn around 2 weeks, roll it out 2 weeks further out, it will be. Let's see, what will it be then? What that time?
Yeah. So right here you'll buy it back for $1.55. And then you'll come out 2 weeks. And what was the strike price?
$51.50.
$51.50. You can sell the new one for about $2.70. So they're going to pay you to wait.
So which one are we looking at? July 17th?
Yeah, that's what I went 2 weeks.
Oh, okay.
So the premium on it for 2 weeks out is about $2.70. So that'll cover your $1.55 that you have to buy it back. Now what you can do if it's going against you, since you only have $1.55 in it, you can look here and come into a 50 and still get $1.70 and lower your strike price by $2.50.
Yeah.
So you can keep working it into your favor.
Right. So are you saying what? Go to 50, so $1.80, between $1.80 and $2.20 is again getting less, but then.
But you're bringing your strike price down, so you're bringing your risk down. So you were obligated at $52.50. Now you dropped it $2.50 on your strike price, and you still got enough to cover your old position that's gone bad.
Awesome.
And that's how it works.
So I'm not stuck with 51.50. I can pick up any strike price.
Absolutely, any price you want. Any price you want. Whatever makes sense.
All right. Oh my gosh, that is awesome. It's fascinating. Yeah, thank you. So, all right. So now my next question is, when I'm selling it, I forgot because this is my second time selling a put. When I go in, I go buy to close is my the trade I'm making, but I'm going to the put side, right? I'm not doing. I have nothing to do with the calls, right? It's just the
Correct.
put I'm making.
You're all on the put side.
You're on the put side, so we stay on the put side.
Yeah.
Awesome. Wow. Right. So
Yep.
what happens if again my market drops it, but that's 2 weeks out. We don't know what's going to happen, right? So I keep doing it, right?
You do it until you're profitable. You can do it for 6 months at a time if you want. Just over and over and over. Just till never take a loss. Never take a loss.
You're awesome. I wish more people could, learn from you. Because it's so easy. The way you explained it, and like to Harrison, I was watching. I mean, I was listening, and I was getting it straight in my mind. And it made sense. The only thing that didn't make sense to me, if Harrison is there, yeah, he's there. Why he wanted a put in the money put? Why he wanted to sell in the money higher than the thing? That's my question. On Cisco, your Cisco, Harrison.
I forgot which. I don't know. I forgot which strike price we were looking at.
But your strike price was in the money. It was not out of the money. See, so I was kind of confused. I want to learn why you want to sell a put in the money, which is higher than the your stock price. Usually you go low.
Yeah, usually I don't think I remember doing that, but if I guess to explain it, if I were to roll over that contract I'm losing from, right? And let's say I roll it out 2 weeks out. I guess my impression would be if I'm going to sell a in the money contract, it would be I'm selling it with the impression that the stock price would be going higher than what it is right now.
Oh, I got you.
Yeah, that's a very bullish strategy. It gets you more premium.
I think I would just go safer and just try to profit off of just a little bit more than the contract I lost with. So like maybe like if I'm rolling over, if I sold a contract at 50 cents and it reversed on me and now it's worth $1 and I'm down 50 cents, I would probably find a reasonable strike price a reasonable contract a couple weeks out where I make that dollar back and a little bit more. So maybe if I'm looking at your Cisco, I'd look at that 48 call or 48 put, which is worth around $1.15 to $1.60. That way I just cover my $1 loss and profit whatever it's there.
So you will go out of the money, way out as low as you can.
Yeah, that's what Randy explained to me, and that just made more sense because you're covering all your risk basically with little to no additional risk. Yeah.
Right. That's why I was confused because you're selling in the money, one step up in the money, and that's what I was confused. That usually you go out of the money below about 68%. That's what Randy taught me. 68 or below.
Mm-hmm.
So I got it.
Okay, guys, I think that's about our hour for this week. So.
Yes. Thank you so much.
I gotta go start.
I learned a lot.
I gotta go start getting ready for some company.
Yep. Before I let you go, one more question. So
Sure.
Now, if I put the trade on, it would be Monday, right? Can I already do it? Like leave it as a limit of this thing, or do market? I usually do market.
I wouldn't. I would wait until a trading day, and you may actually want to follow it because we may get a bounce on Monday.
Yes, that's
it
right.
may come profitable because
I shouldn't be in a hurry. Great, awesome, thank you. We have just kind of picked your brain into, well, you need to get some nourishment and coffee or whatever. And you have a great Saturday. And I'll see you in the evening, Randy, if you care to, because my chit chat will be on from 8, our time. If you want to pop in, if not, that's fine.
Yeah, I'll try.
Alright.
I'll try at least for a little bit.
Sure.
It's just,
Just,
I get up pretty early, so that starts getting
yes.
pretty late for me. So
Sure, that's fine because Dave is always up to something. It's a fun this thing, a very fun a kind of a meeting. So it's up to you. I just wanted to remind you, and I don't want to send you a reminder. Now you know that tonight we'll be on again.
yeah, I'm getting involved in so many streams. My wife's starting to think that I don't live here anymore. So
I know. Poor wives, they're all kind of not very happy. Yeah, very happy husbands. Some women, their husbands are not happy. So,
okay.
anyways, we'll let you go. You have a good weekend, and thank you so much, Randy.
Thanks you too, and y'all. Thanks for showing up. I'm gonna kick the meeting out now. So.
All right.
Thank you. I definitely learned a lot. I'll look forward to learning more from you in the future.
Yeah, we do this again on Thursday at 8 p.m. if you want to drop by for that one too.
Definitely.
Okay, see y'all. Thanks.
See you. Thank you.